But today, what we're going to talk about is debit spreads. So before I get into the whole thing that I wrote up here, basically debit spreads, I highly advocate for them personally because they're a great strategy that could possibly grow a very small account. And instead of risking, just buying a naked call option or a naked put option, you could get yourself into a less riskier situation with more better possible returns. All right, so we're just gonna go right through it, just so we don't, occupy too much time today, since it's already 7:36 at night. So, I wrote things down because I thought I could explain a little bit easier. So, what are debit spreads? Just to let you know, before I'll go through examples through the stuff that I wrote, through drawings that I wrote. I also have some, unfortunately, pictures from Robinhood because that's what most of you guys use, and then we'll actually go into the charts. We'll look at tickers you guys want to look at, and we'll actually look at the option chain to come up with a few example trades. All right. So I know, hearing all of this at first might be just a little bit confusing, but just stay with me. I promise you, I'll make it as simple and easy as I can because I only have 2.4 brain cells. So trust me, it's not too complicated. So if I'm able to understand it, you can too. So what are debit spreads? Debit spreads offer less risk compared to buying naked options while capping profits. So we're going to get into the whole capping profits part a little bit later, but it's the less risk part, which is the nice thing, right? So what exactly do you have to do to enter a debit spread? So basically you have to buy one option and sell the other. So the first thing here that you have to realize is you need a margin account. You cannot use this strategy on a cash account. Uh, I'm pretty sure on Robinhood and almost any other platform these days is actually pretty easy to access a margin account. And JP, if you could start your stream, by the way, it's actually pretty easy to access a live stream margin account. So just to let you know, to use the strategy, you need to have a margin account. Now, the contract you buy is the expensive one, while the contract you sell is the cheaper one. Again, we'll get deeper into it. You pay a debit to enter this trade. So just like, you buy a call or you buy a put, you need to pay to enter a trade, right? The reason why I'm making this very specific is because we also talked about credit spreads. So I didn't want to confuse you guys since this is called debit spreads versus credit spreads. You have to pay a debit to enter this trade. So I drew this whole Venn diagram for what's the difference between debit spreads and credit spreads. We don't need to go too deep into it, but you can kind of glance at it and see what the difference is. If you don't even know what credit spreads are, I suggest you watch the video or the live session we had I think like last week or 2 weeks ago about credit spreads. Basically, sum it up, credit spreads, the biggest things that's the difference is theta is on your side. IV increase is not great for you. You need to give up collateral for credit spreads, and you also receive a credit when you enter the trade versus paying a debit like you usually do whenever you enter trades, right? So what's different about debit spreads is as I said, you pay a debit to enter a trade. You don't have to give any collateral. Theta is not on your side, so theta is again something that will affect your trade, and IV increase is actually good. So for example, if the IV of the contract or the option chain is, let's say, 20%, and the move goes your way, and let's say you got a call debit spread, because you could get a call debit spread or a put debit spread, and then the IV increases. Obviously, we've talked about IV before, so that means your contract prices inflate, which brings you more profit. Now, what's the similarity between the both of them? Lower risk than naked options, right? Especially more for debit spreads because you're risking less capital. And both have max profits, so the profits are capped, and both require a margin account. Neither of these strategies can you do without a margin account. You cannot trade it with a cash account. So what are the benefits of a debit spread? Why the hell am I talking to you about it? Well, first, let's focus on the cons. I've already said a few times, the profits are capped. So that's one con you can have, right? For example, if you bought calls and they end up going like 600 to 800%, even though I'll be completely honest, and I'm sorry for saying this, majority of you guys do not hold your runners, and that's okay. We all make that mistake. But, profits are capped. So, you can potentially get really decent profits with the debit spread. You could get, 400%, 500%, or, 100%. but they are going to be capped at a certain point. And we'll get into how exactly it's capped and so on and so forth. And again, you need a margin account. So, some people might see that as a downside because with the cash account, you don't have the PDT rule. But hold on, let me get to the pros and you'll see why there's a little great thing about the debit spreads. So the great thing about debit spreads, number one, is it's great for small accounts. It's amazing. You'll see the examples I'll talk about. It gives you so many opportunities because the great thing about debit spreads is it makes expensive option chains cheaper. So there's so many times where you want to take, let's say, a Meta trade, a Tesla trade, or even Eli Lilly, for example, because I have an Eli Lilly example, and all those calls, the option chains are just massively expensive, and you look at it like, oh damn, I see a perfect setup, but I can't take it because I can't afford these contracts. Well, guess what? Debit spreads make it way cheaper than what it would be to just outright just buy the naked call option. So another great thing is compared to naked options, this offers more protection, and which basically means less risk. And we'll get into how exactly that is. It gives a greater risk to reward ratio. The reason why I say that is because the profits are a little bit easier to achieve. And again, we'll get into more examples. And it also makes expensive option chains tradable, which is kind of technically tying into this point. So here's the cool part. A lot of people don't know this, but you can use this concept called the ghetto spread, which is basically using debit spreads to bypass the PDT rule, which you have on margin accounts. Now, if you guys don't know what the PDT rule is, basically that means if you have a $25,000 account that, if you have a margin account that is below $25,000, you're going to be subjected to the PDT rule, which means you're not able to trade more than 3 day trades in the course of 5 days or something like that, right? 5 days or a week. So that's obviously a limitation because sometimes, let's say if you're a day trader more than a swing trader, you might want to take, let's say, NVIDIA calls, and you want to leave that quote unquote that day trade or one of the 3 day trades that you have available for, let's say, getting out of a trade that's a loss, or maybe you just want to save it for other times. So we're going to talk about how you can make a debit spread into a concept called a ghetto spread to actually avoid getting a day trade count against you and completely bypass the PDT rule. You can also use it to create risk-free runners. This is something that I feel like a lot of you guys would potentially benefit from, and I'm going to talk to you guys how later. And I'm actually going to use the recent trade we had this week, which is Nike, so that's going to be interesting. Also, I know a lot of you guys are gamblers. I can't help it. I can't change it, unfortunately. But I know a lot of you guys like trading earnings. Well, a debit spread can actually offer you a little bit more safety when you play earning trades, and I'll talk about how as well. And also hedging against longer dated positions. So let's say a swing that's maybe 60 days or even a leap. You could kind of make it into a debit spread to kind of offset any opposite direction from what you want. So let's move on. So how was the debit spreads formed? Sorry, you were gonna say something, JP?
No.
Oh, okay, my bad. I heard something. So how's the debit spread formed? I'm just gonna talk about it simply, and then we're gonna get into the math later on, and I'll make it simple. Don't worry. So it's pretty simple. You buy the expensive contract, as I said before, and you sell the cheaper one. So I need to just get this out of the way so you guys can know it, and then when I get into examples, it'll kind of click in your head. So what is the max loss and the max profit in a debit spread? Well, the max loss is pretty simple. It's just the amount you pay to enter a trade. So just like, if you get into an Apple call and it costs $1.75, that's $175 per contract that you're risking, right? Because if you hold it to expiration and it's out of the money, that's going to be 100% loss. So what you risk is the amount you pay to enter a trade, nothing more. The max profit is the difference of the 2 strikes minus the debit you paid to enter. So I'm going to give you a very quick example before I go on to another example. Actually, you know what? I'm not even going to give that example. It's better if I just show you this. So here's my beautiful drawing of Apple. All right, as you can see, according to this beautiful drawing of Apple.
You can't see a beautiful drawing of Apple.
Oh my God. 1 second. Let me restream my iPad. Give me 1 second. Sorry about that. Still need to set up the whole OBS thing for the iPad, so just give me a second. So I have to use this now sketchy app to stream my screen. Apologies. Alright, thanks for pointing that out, JP. Okay, alright, so now you can see my screen. Am I correct?
Yeah.
Alright. So here's my beautiful drawing of Apple. Current price of Apple is $214.90. That's just what I put down. Let's just say we're looking at a daily chart and we're seeing a falling wedge on Apple, and we're basically bullish on Apple. Let's say we're a really small account, you know, it's let's say it's just $500, and you know, right off the bat, you know, of course, if you're bullish, the safest option you could go with is always going to be the ones that are closer in the money, because the ones that are closer in the money are obviously more expensive, but they have less theta against them, and they're less prone to theta decay, you know, IV crushes or whatever, right? So obviously, if you have a $500 account, is it really logical to put $400 into one trade just because you're bullish on Apple? No, right? Okay, so we're not going to do that. You know, 217.50 calls, that's still $325. Huge portion of the, you know, $500 we have. And then by the time you find you know, an option that works for you for this swing, you're going so out of the money. You're going to 225 and 222.50. And 175 itself is a very expensive contract or a position size for a $500 account. That's over 25%, if not more, of your account. So then that only leaves you with the 225 call, which of course, you know, yeah, it's not a bad option. You know, $75 kind of fits in a little bit more. You know, it is above 10% of your portfolio in one trade. But, you know, I guess it could work, you know, if Apple were to come up here, but then what if it were to reject, right? If it rejects and does this and does this and does this, and then eventually gets to 225, this entire time during this point, you're going to get theta decayed. And you're going to sit there and you're going to feel completely idiotic for losing 40% of this option value or 60% of this option value because you were just stuck in theta decay and you got a far out of the money contract. So how can we debit spread this to give us a little bit of a cheaper option to use safer options and get much more better risk to reward? So let's, for example, take two contracts, right? Because we said we had to buy one and sell one. So I kept on making it very simple. I kept on saying over and over again that you need to buy the expensive one and you need to sell the less expensive one. So let's say we wanted to buy. Why the hell did it turn? Okay, let's say we want to buy the $4, $215 strike. And let's say, okay, you know, all right, I think, let's say this option chain is, let's even go passive. Let's go say it's 15 days out, so it's almost 2 weeks. Let's say in 15 days, I believe Apple will absolutely be above 217.15, 270.50 at the minimum, right? So that means we're looking at these two contracts right here. Well, we're going to buy this one and we're going to sell this one. And from the math I said, right, you're going to basically, you basically have the plus of $4. We'll just make it 400, and we're going to have the minus of 325, which is $325. Now, why is it minus? Because when you're selling a contract, you're receiving credit. So this is the great thing about debit spreads. That's why it makes it cheaper. Because if you're buying this option at $4, if you're selling a contract, you're always going to receive the premium from selling that contract. So theoretically, the premium you receive from that contract you're selling will reduce the cost of the option that you bought. So that is why you take 400 and you subtract 325 from it, and that gives you $75. So the entry cost for this debit spread is just $75 compared to $4. Now that is a huge difference. You're getting yourself two contracts that are close to being in the money, and you're getting at a way cheaper cost than anything else, right? Than just outright buying a contract. So looking at this, you're thinking, okay, what's the max loss? Well, I already told you the max loss is basically what you put in. So if we're just paying $75, then your max loss is $75. Now, what's your max profit? Because I've been nailing in your head that the profits are capped. So if we scroll back up right here, the max profit is the difference between the two strikes that you're trading minus the debit you paid to enter. So this is very simple to understand. So if you take the two strikes, which are going to be 215 and 217.50. So let's do that. So we take 217.50 minus 215, right? That's going to be obviously $2.50. And since we're dealing with options, you have to always times it by 100. So times 100, just like we do it for, like, if if a contract's $4, you times it by 100, and then the cost is 400. Same thing here, you need to times this by 100. So the difference between the strike prices are 250. So then what you do is you take $75 and you subtract that from 250, and that's going to be 175, right? Yeah, 175. So you're paying $75 to get a max profit of 175. So that is just right there is if you guys like using this term, 2-to-1 risk to reward ratio, because it's in fact above it, because 75 times 2 is 150, and your max profit here is 175. So if you want to look at it from a broader perspective, if you kept on using the strategy, basically you would need to get 2 trades wrong to offset 1 loss. So let's forget all of this example. Let's say $75. You're thinking $75. I think that's too risky. It's just too much, right? That's just too much for me. Or let's say you're a little bit more confident in the bullish rally of Apple. Let's say you think, okay, I think Apple's gonna be at $220, and yeah, let's say we think Apple's going to reach $220. I can buy either the 215 or 217. It does not matter as long as it's below the strike of 220. So let's say, for example, I'm going to still buy the 215 contract, and let's say I sell the 220 contract. So let's do the math here. We're going to take $4 or 400, subtract 250 from it, which is going to be 150. So our total cost is going to be 150. Now, what's our max profit? We're going to take 215, or actually we're going to take 220 and subtract it by 215, which are 2 strikes that we're trading here, and we're going to have $5, which times 100 is going to be 500. Then we're going to take 500, subtracted by 150, and that's going to give us 350. So we're risking $150 to make $350. Now, let's say, for example, instead of all of this, instead of taking the expensive contract at $2.15 strike, let's say instead of buying the 215, we buy the 217.50. So this changes, where now we're only buying the contract for $325, and then we're selling the 250 contract, so that's minus 250, which is going to give us, that's $75, right? Yeah, sorry, my math is sucking today. So that's $75. So we're only paying $75 to enter this trade. Now let's do the math for the max profit. So we take 220, we already have 220. We're going to subtract it by 217.50. And this is a little confusing, don't worry, we'll get into a little bit more examples, and it'll kind of click for you. So this is going to be 250, right? 250 minus $250 minus 75 is going to give you $175 profit as your max profit. And then again, you get the same risk to reward. So that's basically the simple math of how debit spreads work. All right. I'm going to move on to an example of a call debit spread that I honestly wish I took today. Let's say, for example, we're looking at Eli Lilly. Eli Lilly finally broke out of this bearish channel. And it broke out with it with pretty decent strength because the earnings report was pretty great. So now, let's say looking at Eli Lilly, we think it's going to go all the way to all-time highs. But you know what? Why risk it all the way there? So what we're going to do is we're going to look at the option chain for Eli Lilly. Now, this is of course on Robinhood. And before I continue with this, I unfortunately do not like Robinhood because for many valid reasons, and its fill times are horrible, the spreads are horrible, and it just does not give you the correct pricing for contracts. And it's like half the times it doesn't fill what you want to fill, and then you're kind of screwed. So you have to keep that in mind if you're using Robinhood. But since most of you guys do, I understand it. And, at least one thing that I can say Robinhood is at least okay for is actually debit spreads or credit spreads. Because, when you're dealing with debit spreads and credit spreads, if you go to amazing platforms like Thinkorswim, you are going to be dealing with commissions, which could eat into your profit. By the way, if you guys have questions, I'm going to answer it after I get through this. So just looking at this Eli Lilly option chain, I mean, right now, the price of Eli Lilly, if we scroll to the bottom right now, is $867. For contracts that are not even at $867, the 880 calls are $10.95. With a small options account, it is almost impossible to trade that. If you have $500, forget about it. Even if you went far out of the money, this is 8 days out, so this is next week. This is a screenshot I took like 1 hour ago. If you wanted to get the $900 calls, or $900 strikes, you're paying $500 to enter that. That is absolutely expensive. And when you have such a great setup on Eli Lilly, and you want to trade Eli Lilly, but you can't because the options are expensive, it completely limits what you can trade. A lot of great stocks have very expensive option chains, and you can't limit yourself because you're too cheap or you can't afford it at that time. These stocks like Eli Lilly, they move very well if the price action is there, if the patterns are there, they move really well. So why would you limit yourself because you can't outright buy the naked option? Why not make it a debit spread? So we're going to look at this example right here. Looking back at Eli Lilly, let's say, this is 8 days out, so that's next week, expiration of Friday. Let's say we think by Friday, Eli Lilly is going to get above $900, right? Because today it almost reached $900, right? Today's high was $887. So the peak was $887, which is only $13 away from Eli Lilly. And let's say we have our, indicators, or let's say our technical analysis that's saying, hey, even if Eli Lilly chops for a day or two, I think Eli Lilly is going to go up above $900 or even, $910. Let's go back to the option chain. We talked about how, we can make a debit spread and make it cheaper. Well, obviously, the farther out of the money you go, the cheaper the debit spreads will be, which means your risk to reward will be a lot greater because you're risking less to make a lot more. Of course, you could take these debit spreads down here. They could be potentially much safer, but you are paying more, which then makes it a little bit harder for smaller accounts. So what's a possible debit spread you can do here to get a great risk to reward? Well, what we can do is we can look at this 900 and 905 calls. So I brought out the screenshot because I wanted to show you how you would build it on Robinhood. Now you can see here on the top, on the desktop or the web version, and also on the mobile version, you'll see here there's always going to be this tab called buy and sell. You have to make sure that if you're trying to get into a debit spread, you are correctly making sure you're choosing the correct option when you're entering into each contract. So when you're buying this option, for example, the 900 call, you need to make sure you're on the buy section and you're clicking this contract. And then when you want to sell, let's say, for example, the 905 call, you need to make sure you're clicked onto the sell thing and then sell tab, and you're then selling this 905 call. The way you could also confirm that you're in a debit spread is when it actually says on the top over here, on your mobile devices as well, it says call debit spread or put debit spread, whatever you're looking at. And you have to pay a debit instead of receiving a credit. So over here you could see estimated max cost is 165, and we'll get into math again. If you had it wrong, then it would say like X, I think it would say like maximum like credit received or something like that. So you always want to make sure it says cost and not received. For a debit spread, it always needs to be cost. So looking at this very quickly, we'll do the math without having to write it all down. You take the difference of the two premiums, so that's $500 and $335. If you subtract both of them, that'll equal out to $165. So that's the amount we're paying, $165. And then you subtract these two strikes, so $905 subtracted by 900, which is 500, and then $5 times 100, which is 500, and then you subtract 165 from 500, which will give you the max profit of somewhere around 340. Because it's after hours, the spreads are all wonky, and Robinhood is not showing it correctly. But this is the great part is, for example, Robinhood makes it simple for you to look at on a lot of other platforms as well, because it will tell you right here what your max profit is, what your max loss is, and what your break even is. We will actually get into the whole option calculator and actually showing you how the profit works and so on and so forth. But one thing I want to hone in is the max profit you keep seeing, that is only reached if the price of the stock, for example, if you're in a call debit spread, if the price of the stock is above the two strikes that you're entering in this trade. So what that means is by February 14th, right, because these are the expiration we're looking at, Eli Lilly needs to close above $905. If it closes above $905, then you then get the max profit of $340. I know it's a lot of drawings right now, so sorry if it's messy, but hopefully this makes sense. And we're getting into a little bit more examples so it makes sense. But that doesn't mean that you need to hold this contract till expiration. Since you're buying the expensive contract and you're selling the less expensive contract, if the stock goes your way, and let's say you get a call debit spread and the stock rises, you could sell it much earlier than the expiration date. For example, if we entered into this, this call debit spread, and let's say right now we saw the price of Eli Lilly was $867, right? Let's say we entered this call debit spread today, and it ended up going, tomorrow it gaps up and it goes up to, let's say, 900. That call debit spread might be up 50%. So it'll go from 165 to like 250. And then your profit would be around like $80 per debit spread, which is around 50%. So you could just exit right there. You don't need to hold the expiration. You got yourself a cheap contract that's less risky than just buying a naked call. And also, you can just sell it the next day if it's going your way, right? So you don't need to hold the expiration. I just want to make that point very clear before I move on. And don't worry, soon, all these slides will end. I know this might be boring you, but just want to make sure you guys understand. So in the previous example, we talked about, just 8 days out. It's not far ahead. Whenever we buy options, the rule of thumb is the more time you buy, the bigger the probability there is for your outcome to happen, right? So the probability of it happening increases a lot more, because the more time you have, the more time, things work out, especially when it comes to bullish scenarios versus bearish scenarios. So let's say, for example, we go farther out and we look at March 7th, which is 29 days. And let's say by March 7th, which is almost a month away, we believe that Eli Lilly will come close to, if not above, the all-time high of Eli Lilly, which is 972.53. Okay? So we think, okay, in almost a month from now, Eli Lilly is going to break all-time highs, which, by the way, it kind of looks like it will, just my opinion. And, okay, we're like, okay, all right, we're very bullish on Eli Lilly. Now, what we can do here is we could get it farther out, which is, again, for example, the March 7th, 29 days out. And we can go farther out of the money. Because, if we go farther out of the money in the debit spread, our costs would be lower and our max profits will be higher. So for this example, I am buying the 950 contract and I'm selling the 970 contract. Again, simple way to figure out which contract you're buying and selling. You buy the expensive contract, you sell the less expensive contract. So right away, you could do the math, try to figure out what the max cost is. What the cost is, but it's also over here. I typed it out. So the max cost for this debit spread is $279. I already told you the math. I'm not going to go over it. And then the max loss, again, you could do it very quickly. $20 is the it's just the max loss is right here. I'm not gonna. You already know the math. I already talked about it. I don't want to bore you guys even more. So the max loss is $270, and the max profit, if you see right here, is $1,730. And you're like, whoa, hold on, wait. We just went from a call debit spread that just gave us a max profit of 340 versus a debit spread that's now giving us $1,730 max profit. Again, this max profit is only reached if the stock is above the prices we're looking at by expiration. But how the hell did we go from 279 to risk that much, to get that much? This is where debit spreads shine, because you can risk such little capital for a long-term trade and get amazing rewards in return if it works out in your favor. If I were to do this math right now, let's just round the max cost. Let's say instead of $279, it's $3. So that's $300. And the max profit, let's just round it down from 1,730 to 1,700. That is over 5 to 1 risk to reward ratio, right? Or whatever, 1 to 5, however you say it, right? You're risking $300 to make possibly 1,700 by expiration. Tell me this risk to reward is not great. Now, of course, if you had the capital and you bought the $950 call, which is just $5, and you held it, that call, if Eli Lilly just went straight up, that call will absolutely give you more gains than having a call debit spread. But think about it realistically. How many of you guys actually hold till expiration, or how many guys actually hold the call for a very long time? Eventually your fears will creep up of, oh my god, theta is going to creep in and stuff like that, which happens. So this is why debit spreads kind of make it cheaper and also offset any potential losses, your theta decay you can have when you're trading these options, right? Now here's something interesting you can do. Let's say you have the capital to trade Eli Lilly comfortably, right? So it doesn't matter to you if the contract actually is $5. Let's say, Eli Lilly is going your way, but then all of a sudden it reaches a level and you start thinking, okay, Eli Lilly went from 887 all the way to 925. I think it's going to hesitate here. What you could do is, let's say you only have that call, you could make it into a debit spread, and you could sell whichever option you want to help reduce the losses you will have when, let's say, Eli Lilly chops or has a little bit of a pullback. Because we all know the strongest rallies happen when it rallies, consolidates, or pulls back a little bit and then rallies again. So if you were to sell this contract, right, let's say the 970 call, or even the 980, whatever call you want to sell, that credit you receive will help reduce the cost and also give you a little buffer if the stock were to just hang around for a while or retrace. Now, how does that work? Well, if you guys remember, when we talked about credit spreads, I talked about the main thing you have to understand is when you sell an option, if you're selling to enter an option, you obviously profit if the value of the option decreases. So let's say, for example, Eli Lilly goes, let's say we had this 950 call for a while on Eli Lilly. and now it's valued at $5. Let's say currently, as we saw, the price of Eli Lilly is $870. Let's say at $870, we think, hey, Eli Lilly's going to stutter here. We then sell this call additional to, we already bought this call a while ago. And let's say now we want to sell this call. You could sell this 970 call. And let's say Eli Lilly retraces from 870 all the way down to, let's say, 846. Now, what's going to happen here? It's very simple. Keep it very simple. What's going to happen is, yes, the call you bought will reduce value, but also so will this call. And if I just told you that selling an option, you profit off of the decrease of value in the contract that you sold, you're profiting off of the decay off of this contract. So let's say if Eli Lilly goes from 870 to 846, this contract might go from $2.21 to, let's say, $1.15. So then you get yourself, or $1.20, so let's make the math easier. You get yourself $100 profit, and this $500 contract might go from $500 to $335 or $350, which is then an unrealized loss of $150, right? Or not an unrealized loss, but just $150 lower than $550. But then since you got $100 profit from selling this contract, because you made this swing trade into a debit spread, you then only have a $50 decrease from the high point of $500. So that's one way you could potentially hedge any longer dated swing calls you have, right? Now, how do we do debit spread for earnings? You guys all remember the IBM's earning trade I had last week. The contracts went 800%, amazing trade. The setup was there. It was absolutely beautiful. Let me pull up IBM's chart. So the same day I entered into calls, I personally had, I've been doing a small account challenge, and it's an account that just has, I think it started with $400. Right now it's at $661. And one of the trades I took was this IBM earnings trade. Now, of course, earning trades are always risky because the setup can be great. And yes, there are technical factors you can look at that gives you a higher probability of you getting a little sentiment of possibly what can happen. But in the end, there's still a lot of risk to earning trades. But how can you make a possible earning trades safer and cheaper? Well, here, for example, we have the debit spread I got into for IBM. I got into this debit spread literally like a minute after or 2 minutes after I entered the calls that I posted to you guys, which I believe was the 250s, right? So I entered this call debit spread, which if I scroll down, you'll see that I bought, let me use the pointer here actually. I bought the 247.50s and I sold 250s. So basically I'm betting here that I believe that IBM by expiration, if you could see the expiration was actually the same week, or actually the week after, so 2/7. So this week, that IBM will close above $250. Now, doing that, I reduced my price of these contracts to $50. To this debit spread is only $50 cost. Now, if you look at the strikes over here, you could kind of figure out what the max profit is. It's 250 minus 75, right, because it's 250, right? That's the difference of the strikes. So 250 minus 75, which equals 120. You know the math, right? So basically, the max profit is, wow, I'm blanking out here, man. Sorry. So $250 minus $50, the max profit is $200. Sorry about that. I'm running on 2 brain cells now. So the max profit was $200 on the spread. I'm only risking $50 for this. $50 to get a max profit of $200 if it goes my way. Tell me how that's not a safe trade in terms of risk to reward. Not in probability of it happening, but in terms of risk to reward. Now, because I have multiple accounts, and obviously IBM went our way, but because I have multiple accounts, I unfortunately couldn't pay too much attention to this IBM debit spread. I exited, unfortunately, at $1.40. So I made a profit of $110, right? Because my entry, no, damn it. I made a profit of $90 because my entry price was $50, and if I'm exiting at $140, that's a max profit of at $90. This also was exited the next day. So right after IBM earnings happened, and then the day it opened, and we were massively all up on our contracts, right? I literally exited this trade right like 2 minutes after open. If I actually held this trade till today, or even earlier, it actually would have reached the max profit because this put debit spread was so far deep in the money. Because the price of IBM soared all the way to 264, which was my original target. So instead of, if I held this, instead of exiting at $140, I would actually exit at 250. And my max profit, instead of just being $90, would actually have been 200. So this is a great way you could possibly trade earnings. And I'll actually show you another example a little bit later on. Now, this is the last slide. So finally we're getting over with the boring part. But how do we do risk-free runners, right? Let's take that Nike trade we had, for example. Over here, as I said, I have multiple accounts, and one of them, I decided, hey, you know what? Since I'm having a debit spread live session, let me actually debit spread one of my contracts to show you how exactly you can create a risk-free runner from a swing that's doing really well. So if you guys remember, we entered the Nike calls for 81 cents. By the next day, I believe the contracts went above I think they were $1.15, $1.50. Let's just say $1.15. So since obviously Nike was going up, that means all the other options in the option chain for Nike were going up as well for calls. That meant the call further out of the money for that same expiration was gaining value as well. So since I bought the 80 call, I then saw that the 81 call the same day when I was already very up on my Nike call was up as well. And in fact, it had gained significant value. I think it went from 50 cents to 76 cents. So I'm like, you know what? Let me sell this 81 call, receive $76, and basically reduce my cost for this option from 81 to $5. So all I'm risking is $5. Now the max profit, obviously, is going to be 100 minus 5, because 100, where'd I get 100 from? That's the difference of these strikes times 100. And then you subtract $5 from it because that's the difference between these two options. So the max profit would be $95. So I'm basically making this almost close to a risk-free runner because I'm almost receiving back almost the entire cost of this $80 call that I bought. In fact, if I actually had waited a little bit longer to enter into this 81 call and make this a debit spread, I actually would have gotten this call at I think 85 cents. So I would have made this a risk-free runner plus more. Now, how does this? You guys might be asking, oh, what's the point of this? Why can't I just let it run to zero? Or let's say put a stop loss. Well, if you put a stop loss, then of course, if the trade goes against you for a temporary short amount of time, you might get stopped out and then you're completely out of the trade. And if you hold just risk-free runners, you're risking the entire amount of the contract you originally bought. So if you do a debit spread, you're reducing the amount you originally, spent, and you're also just making a lot safer and a bigger probability for this trade to be profitable because you're giving yourself a max profit. And eventually, if it expires if Nike, rallies up by February 21st above $81, this debit spread will reach its max profit of $95. Which, if you compare this right here, $5 to make $95, That's I think that's almost that's above 800%, is it not? So you could see the risk to reward that debit spreads get. Now, the other thing we were talking about that I said earlier was ghetto spreads, which is how you can avoid the PDT rule. That I would actually have to show you on the option chain. We'll get into that. Before I move on, I do want to ask you guys if you can at least start asking your questions now. So before I move on to the examples, at least the examples will be a lot clearer and stuff like that. And yeah, so you guys could go ahead and ask your questions. JP, do you have a question you want to ask me?
Yeah, I just want to go back to something that I think a lot of people are going to ask. And you had mentioned about collateral. Can you explain the collateral concept when it comes to taking these type of trades? How much collateral do you need to have? And one of the biggest problems that you have when you take spreads is that you have to put it up, which is why you have to have a margin account. What's the purpose of putting up the collateral on some of these trades?
So debit spread does not have collateral,
For the credit spreads.
but we're not talking about credit spreads,
Oh, I'm so sorry. I thought we were talking about credit spreads.
bro. JP, I'm gonna smack you, man. This whole I've been talking about debit spreads the whole time, dude. What? I'm just kidding. But yeah, no, debit spreads do not receive any collateral, but still, it's good you brought it up because I just want to clarify this. The only money you're putting into it is the cost that you're paying to enter the trade. So if I'm just paying $75 to enter the debit spread, I'm just only risking $75. There's no collateral I need to put up. The collateral only comes for credit spreads, which I won't go deeper into because we already had a video on that actually. So
Mhm.
you guys can feel free to watch that if you have any questions about collateral. But yeah, if you guys can ask, you can ask your questions. There's no such thing as dumb questions, so feel free to ask it. And then we'll get into the examples that I want to show you guys. And by the way, while I'm going through these examples, you guys can also put on stocks that you want to look at, so we could kind of figure out like, hey, what kind of debit spread would I do at this point? So, all right, let's go through a few here. Yeah, good note 6 is amazing. So debit spread is technically a cash account. Wait, cash account where a credit spread is margin account? No, you need a margin account for both. A debit spread requires you, because basically the way so there's this thing called option strategies. Obviously, debit spread and credit spread is considered an option strategy, and to use an option strategy, you need to have a margin account. That's just unfortunately how it works. Um, I I don't think JP, can you have a cash account and do a debit spread? I don't think you can you?
I mean, I've always had a margin account, and I haven't taken any spreads on my cash account.
Hold on, let me ask my beautiful OnePlus phone. Okay, Google, do you need to have a margin account for a call debit spread or put debit spread, or can you have a cash account? Yeah, so yeah, so you like 99% of brokers will or platforms will require you to have a margin account. You can't do it with a cash account, from what I just read. But of course, you guys could do your own research. But I'm pretty sure that's why I said like you need a margin account, because I've always seen that you need a margin account. So this is a way of hedging because you're receiving collateral, so you're reducing the cost of your option while also making the risk to reward potentially better, because you're kind of offsetting a little bit of the theta decay. Because as I said, since you're selling an option, you are that option that you sold, you're profiting off of the theta decay. And let's say, for example, that option you sold ends up going to like, you know, like you and that leg itself, the contract you sold is like, it shows like 50% or 80% profit, and you think, okay, for example, Eli Lilly, right? Let's say, let me go back to an example, just because I want to reiterate this, because this is nothing has to be static in trading. That's the thing. Nothing is just, oh, you need to do this and you need to do that. You can always be creative. And again, it's all based on your risk. So let's say, for example, we go back to this example. If this if let's say we do this call debit spread and Eli Lilly, shuffles around for a bit and this 970 call reduces from $221 to let's say $110 and you're thinking, okay, I really think right now Eli Lilly's going to bounce and actually make a very volatile move to the upside. You might as well just close this leg that you sold because when you do that, you now have a reduced cost, right? Original cost on this call that you bought. And now when if Eli Lilly did go your way and Eli Lilly does catapult, you're not going to be capped on your profits, right? So that's the thing. You could be flexible with this. If it's like how many times have you gotten into a trade where it's been like, it has an amazing bullish setup, let's say swing trade, and it just like you buy unfortunately right over here, but it just sizzles for a little bit, and then it rallies. But then unfortunately during this whole time you get thetaed. That's when you could get into a debit spread right over here. And let's say you get thetaed over here and this contract loses value. Around this point, if you think, okay, this is a support, it's going to bounce here, you can close out of this call, just keep this call, and now when this call gains value, because let's say for example Eli Lilly increases in price, you will now have a bigger profit percentage compared to having the debit spread, if you get what I mean. So you can be very versatile with this. Just like I was very versatile with, for example, bringing up the risk-free runners thing. It's not like, oh, debit spreads, I need to keep the leg that I sold or the contract that I sold the entire time. If you're seeing that, hey, it's gonna go the way I want to, then you can just exit out of that trade. But then remember, if you have a small account, you then will have to have enough to afford the the expensive contract, because to exit a contract that you sold, you have to pay back the amount of the value. So if this contract, let's say when you want to exit it, is still at $2.21, even though you receive $221, you have to give back $221 because that's the value of the contract at that time. Let's say, for example, Eli Lilly goes down and this contract right over here becomes 110. But even though you receive $220, you only have to give back 110, which then gives you a profit of $110. So that's why you want to just keep in mind that if you have a small account, maybe it's not so great to close out of this leg, because if you can't afford, or if you're going to be putting yourself in a risky situation, because then you would have to take on the entire cost of this option that you're buying. Hopefully that makes sense. Which do I recommend, Webull or Thinkorswim? Well, again, JP and I, and no one here is a financial advisor. None of us have licenses, so I'll just give my personal opinion. I've had my greatest experiences with Thinkorswim. It has the best fill times out of all trading platforms that I've ever used, and I've used almost 99% of them. One thing you could say that might not be so great for spreads when it comes to Thinkorswim is the commissions cost, because the default commissions is 65 cents to enter and 65 cents to exit. So if you're entering two contracts into each debit spread, that's 65 times 2, which is $100 to enter and then $1.30 to exit. And then you multiply that by the amount of debit spreads you get, and then the cost kind of, increases. So then what are your other alternatives? Well, if you want to have superior fill times as well, you can use this platform called Tasty Trades, and I'm not sponsored by any of these platforms. You can use this platform called Tasty Trades, which has a cap on how much commissions you're charged. I think it's $10. So if you can only get maximum charge $10 on a single trade you're taking. So Tasty Trades is really great for spreads. You can check that out. Webull could be like a third option. Reason I say it's a third option is because it says it's no commissions, but it is commissions. It's just very small. But it at least will give you cheaper, like very cheap commissions. I think it's only like 3 cents or 1 cent. And the fill times are not the greatest. I've always said in my rankings, Robinhood is at the lowest. Robinhood is the worst, right? And Webull is only just one step above it. Do not get fooled by Webull. It is not by any means a great platform. All it does is just give you one step above Robinhood. Your fill times are not as great as the greater platforms like E-Trade, which is multiple steps above, and then Tasty Trades, which is above that, and then of course on top is TOS. And this is not bias. This is a fact in terms of fill time. If you compare, if you have Robinhood, and if you were to compare your fill times on TOS, you'll be shocked. And if you look at the spreads on Robinhood and Webull, and you compare that to TOS, which is Thinkorswim, which is owned by Schwab, you will be surprised at the difference there will be in some option chains. So that's my personal opinion on platforms. For example, JP, by the way, uses E-Trade Pro. Um, do you have to have a margin account to use multi-leg strats? Is that why? Yes, to have multi-leg strats. Thank you for simplifying it. When you have basically, when you're entering into one trade and that trade consists of two different contracts, you need to have a margin account. May I ask, how did you choose the strike price of IBM? I did a debit spread of a firm for 63 and 65. It's now 70, but it seems I left a lot of money on the table. Yeah, absolutely. We'll get that actually. I did a, by the way, I did a firm debit spread, I think. I don't know if it filled, but I did that as well. So we'll get into that. So I'm going to save that for later. So the margin account has a minimum balance, so it's like a collateral put out, 25K. So small accounts cannot take debit spreads because of balance. That's not true. Right now, if you have, you don't need to have a minimum of 25K to trade a margin account. You need to have a minimum of 25K to avoid the PDT rule, which then, which basically limits how many day trades you could take. The 25K is the minimum balance you need to avoid the PDT rule. You can start a margin account. I think with Robinhood, I think the minimum is like $200. I could be completely wrong. Could it be even lower than that? Because Robinhood has like just wants everybody to use it. I think with Thinkorswim, you need to have $2,000 to have a margin account. It kind of varies per platform, but if you like, for example, if you only wanted to trade $500, then maybe the platform you unfortunately would have to use is Robinhood. I'm not exactly sure at the margin requirements or what the minimum balance needs to be for Webull, but it definitely is not 25K unless your platform that you're using is putting that limit for you. Then that's of course dependent on your platform. But I know for a fact, Robinhood, you can get margin for a very low amount. You could just have like, I think $500 you could get it, because I mean the Robinhood account that I'm doing right now, using right now, if I go over to Robinhood, I'll show you the small account. Yes, hello. Right now is $656, right? That's very cheap. And this is a margin account because I took the debit spread, which you guys saw earlier, on that Robinhood account right there. So it varies per platform. So you want to check, but I'm pretty sure Robinhood is very low. Also, I notice it's a lot harder to fill a spread. Sometimes I can't fill even I put an ask. Any tips on filling these cons? Well, absolutely, of course. When you're trading, when you trade any type of spread, it is going to be just a little bit harder to trade, to enter versus just entering one option, because you're dealing with two option prices, right? So one thing you want to look at is obviously the platform you're using, because Robinhood makes it a little bit harder to enter into debit spreads. And then sometimes, the great thing is, debit spreads, you could just, I mean, any trade in general, you could just keep on adjusting the price. The way I like always entering into spreads, take debit spreads, for example, I always want to start at the cheaper amount and keep on just trying to increase and increase gradually until it fills. The reason I do this is because I want to get the cheapest price available to me. So, yes, of course, debit spreads might be just take like a few seconds more to fill than, of course, just buying a call outright. But yeah, that's one downside, I guess you could say, right? So say I buy a call at $2 and sell another at $1, my maximum loss is $1? Yes, because your entry price is $1, right? So since you're buying a call at $2 and since you're selling the call at $1, remember, when you're selling an option, you're receiving the value of that contract, you're receiving it. So since you're paying $2 but you're receiving $1, your maximum cost is $1, which then of course is your maximum loss. So there's lower risk inherently because the natural hedge against the time decay in IV. Yes. So it's not just a hedge because, hey, I'm reducing the cost. It's also a hedge because theta, you benefit from the contract you sold. So that's how you kind of quote unquote hedge it. Interactive brokers is great. Yes, absolutely. It's a great platform. I have nothing bad to say about interactive brokers. Webull minimum is 2K for options, and you have to opt in it. But once you're below, you'll automatically opt out. So whoever using Webull, try to always keep it above 2K for options. Okay, so that's interesting. Um, Someone has to confirm for me then what the Robinhood threshold is, because I know years ago it used to be like 100 or 200 minimum, and you could just get a margin account. I don't know if the rules changed. If someone could correct me on that, that'd be great. But yeah. So just to confirm, they're also known as bear calls and put. Yeah. So it's just like buying calls and buying puts. If you're bullish on a stock, you would look at a call debit spread. If you're bearish on a stock, you look at a put debit spread. So everything I just talked about today, we'll get into a put debit spread example with Amazon because Amazon had earnings today. It's the same thing. It's just the opposite. For obviously for put debit spread, it's just the opposite. But it's the same math you're dealing with, same contract, same theta. All that. It's just all the same. It's just you're taking puts instead. You buy the expensive contract, you sell the less expensive contract. Nothing more complicated than that. It's just different name. Full call book. Yep, great lesson. Learned a lot. Thank you for that. So now they increased it to 2K on Robinhood. That can't be right. That's insane. If that's the case, that's insane. Ooh, that's ugly mirror effect. All right, you're lost already. Yeah, I hope it was able to become a little bit less complicated. Because it's always complicated at first, but then once you get into examples, at least for me, that's when it makes it a little bit easier. Sorry, no, Yep, theta's always going to be against you. The only time where theta is on your side is credit spreads or when you sell options. So please check those videos out about credit spreads, because theta can be on your side. So check that out if you haven't. I'm sorry, man. Yeah, my screen was frozen. What else? There's no way. No, there can't be a 25K minimum limit for Robinhood because I placed a debit spread on it, and you guys saw that account. I could show it again. It is at $656. This is an account right here. Buying power 647. Right? I'd like, it's an account, and if I'll go to the history. Let's see, history, all accounts, let's say individual. You could see right here, I entered into this debit spread. That was not a fake screenshot, right? It's right here. So I am not sure where you guys are getting that information from. That 25K minimum, again, I'm pretty sure that has to deal with day trades. So again, you can
25K day margin requirement is only for pattern day traders. It has nothing to do with this.
Okay, cool. Got you. Yeah, 25K is for not getting flagged. Thank you. And yes, everything will always be posted on YouTube as long as the recording doesn't get, what's it called? Scotched up. No minimum needed in RH to trade, just enough money. Okay, at this point, I mean, I guess the best thing is to just figure out you guys yourself. If you have, for example, if you have a cheap account, if you have $500 in a Robin account, maybe you could potentially try making it into a margin. And if it works, then there you go. It's a margin account. Then you know the requirements. But yeah, so I don't know if the rules change. Again, I don't want to stick on this topic too much because you guys could do your own research on that. I kind of want to save some time and head into the examples, but you can definitely figure out by yourself. And from what I remember, Robinhood had a very, very low requirement for margin. So let's get into, so for example, going back to the question over here where we had about price of IBM, how I guessed that. Well, first of all, the all-time high for IBM before it broke up after earnings was 239. So whenever you're trying to look at trades and all-time highs, I'm not going to go too deep into this because that's a whole nother subject. But whenever you're dealing with stocks that are going to break up into the upside, into all-time highs, you have to start looking at either two factors. One is gamma levels, so that refers to the options. So you can look at options that have, let's say, high open interest and stuff like that, All short squeezes and gamma squeezes, that's a whole nother topic we'll do another day. So you could either look at that or you could look at psychological levels, right? Because a lot of people always sell at a level that seems perfect. So like they would sell at 250, right? Because 250 is a perfect number. So that's where I got the 250 number for. So I'm like, okay, all right, if IBM were to beat earnings, where would it potentially reach in 2 weeks? I thought, okay, if it breaks all-time highs, which is 239, 240, okay, that's a great number, but what if it reaches 250 because that's a better psychological number than 240? The best psychological numbers are, the number one is it always ends in zero. Number two, it always ends in one or five. And number three, it has to be an even number. So that's the order in the psychological numbers that you look at. So if we go, for example, to a firm, you guys have heard. I think last live session I talked about how bullish I am on a firm because it has an amazing setup on the daily and the weekly. And if this were to be earnings, this would skyrocket to the upside. Now, I personally bought shares for this. I think I bought a debit spread. I don't know if it filled. I had to check on my Thinkorswim account later because I was out and I was busy. But let's say we're looking at a firm right now. In fact, I'll actually pull up the option chain as well. So if we go to a firm, let me pull up a firm, and then we'll talk about targets when it comes to when it comes to earnings, right? So let's go back to a firm. What's their targets here? Well, we could see the previous high was, you always want to just figure out what the previous high is. Because if a stock, for example, if you're bullish on earnings and a stock is actually performs well on earnings, then you want to look at what the previous high was, because it's more likely than not going to eventually test it. So our previous high was around $72. So our first target, if you're taking a longer dated debit spread, longer dated meaning 2 weeks to 4 weeks out, you automatically want to already be looking at the 72 and the 73s, because that's our previous target. You can say, hey, why aren't you looking at 67 because that's a previous high? Absolutely, you can look at that. I mean, it's not, if your trade's going to end up in profit, you can't really look at it and be like, oh damn, I should have, done this instead. No, you got a good trade. Stick to that, right? But you have to realize getting a debit spread farther out of the money will always be riskier in terms of less likelihood of it working compared to a debit spread that's closer in the money. So to say for a debit spread would have been like a 68-67 call or a 68-65 call debit spread versus, let's say, a 73 to, I don't know, 68 call debit spread. So we'll go into the option chain over here and we'll look at the availability that a firm had before earnings today. So when it comes to earnings, I don't like going far out. I personally do not like going past 2 weeks, because then, the risk reward, yes, it's still there, but it's a lot more technically on the closer dated expiration. So I first will look at, for example, February 21st. Now, let's say we're looking at the passive amount. Let's say we're looking at, okay, we think a firm's going to reach $68. We could see here, unfortunately, since a firm already gapped up from its price of 61 to 70, it's going to show that the share price is 70.98. But at close, obviously, it was 61.75. So we're going to go down, and we're thinking, okay, $68. We think that's where the a firm will be by February 21st. So we're going to sell the 68 call, and then we're going to buy a more expensive call. Now, let's say if you want, you want more max profit, you of course need to get a wider spread. So let's say you want to look at the 68 and 65. Let's look at this debit spread. Your cost will be, let's see, 420. This is going to be screwed up, unfortunately, because it's after hours, so spreads always go a little bit wonky. But you could see, if you subtract this, let me do the math really quickly on my calculator. 420, and you don't have to pull up a calculator during trading hours. Unfortunately, I had to pull it up because it's after hours and near the last seconds, the the contract spreads always go a little bit wonk, especially during earnings. So if we do 420 minus 294, you see our max cost will be 126. So that will be our cost, 126, right? Max cost, and you'll see our max profit is 180 versus our max loss is 120. So you're like, okay, you're thinking, okay, maybe that's not the greatest risk to reward. So what you could do is you could then buy a contract that's a little bit closer to the contract you sold. Let's say that'll be the 6750s. And if you were to do the math here, right, 320 minus 294, geez, sorry, 320 minus 294 is $26. So we're going to put in 0.26. This will again automatically pop up if it's shown during trading hours. And you'll see here you're risking $20 to make $30. So you could adjust these spreads to find something that gives a lot better likelihood. You could go farther out of the money, you could go farther out. If you were to, let's say the previous contract, I think that was how much cost was it? It was 126, right? So if you want to equate the amount you would do for that spread, 126 divided by 20, that's around 6 spreads. Or let's just reduce it to 5 spreads. You're risking 130 to make 120. So obviously you need to change, you need to go around and you need to figure out what makes the most sense, risk to reward, to be able to find a good earnings trade for you. As you saw, the IBM was a really great trade because it gave a really good risk to reward. You could see here, just judging by the premiums we're seeing on a firm, that this passive spread on a firm is not really doing that great because the expected move of earnings was pretty big. So this is a very passive spread. So that's why I personally would not look at this, because as I said, you want to look at the biggest previous high that you had, and that's all the way up at $72. So if you go back to the option chain and we remove these two contracts and we look at, okay, we think a firm in 2 weeks by February 21st will close above the previous high, which is $73, which is 72. So we think 73. We're going to go up and we're going to see, okay, all right, the only strike we could get here is the 72.50. So we're going to sell that and we're going to buy, let's just try out the 71 call. So if you subtract the prices, because unfortunately I need to subtract it since it's after hours, 230 subtracted by 165, your cost is going to be 65 cents, which is $65. And then you start getting a little bit better risk to reward ratio, right? You're risking $60 to make 90. Adds about like 1 to 1.5, I think, right? Something like that. Or 1 to 0.5, something like that, right? And then if you want to become a little bit riskier and get a better risk to reward, and you think, okay, in 2 weeks, I actually think, right, we've gone over fib extensions, so you could check out fib extensions. If you think the firm is going to hit $83, now if we go here and we go to 80 and we see, okay, the only closest strike is 80, let's sell the 80 call and you buy the 77.50s and you do the math here. It's getting annoying. I have to do the calculation. I wish it was more updated. 53 cents, right? You're risking $53 to make 197. So that's where you start getting better risk to reward. The farther out of the money you go, the better risk to reward it is. Of course, there's less probability of it happening, but you get a better risk to reward. If you were to go closer, you see here that if I were to do the same thing, if I were to guess that by, when is this, next week, a firm was to at least reach $78, I go to 78, I sell that, by the 77, 83 minus 59, I don't have the brain cells to do the math right now, sorry, so I'm just gonna do this right here, 24, oh, actually, it doesn't show it anymore, great. All right, so 24 cents, I'm risking $20 to make $80. And then you'll see the risk to reward there is 1 to 4 or whatever it is, like 1 to 3, right? So that's how I would do earnings. I would look at the fib extensions. Again, they're one of the most useful tools you can use to have price projections of where a stock will go. So that's what I would look at for earnings. So hopefully that answers your question. I'm going to go to Amazon and then I'll get to the rest of your questions because I want to show a put debit spread example. let's say for some reason you're bearish on Amazon, just a hoax or just a feeling, whatever, and you think Amazon is going to go down to 228 or 230, let's say, we can go here, we could type in Amazon. And I want to show this because I've been only showing call debit spreads, but I want to show put debit spreads. We could go onto the option chain for Amazon, and let's go to next week's. And let's say we're on the put side, we think it's going to reach, oh wow, it actually is. That's actually crazy. I'll be completely honest with you, I did not know the price of Amazon was actually at 230 basically. So we think it's going to reach 230, so we're selling the 230 and we're buying the more expensive contract. So let's, for example, just buy the 230 250s. And you're going to do the math here. Very simple math. We're going to take the expensive contract, which is 545, subtracted by 445. And that's going to give us a max cost of $1. I could have done that math right in front of you. I don't know why I had to pull up the calculator. You see the max loss is of course what we paid, and the max profit is 150. If we were to go farther out, right, farther on expiration, of course will give us more value, and so on and so forth. So that's how you do put debit spread. Not going to unfortunately do it because I don't want to repeat things you guys already know. So yeah, do you guys have any questions before I go over the whole ghetto spread part where you can use this to avoid the PDT rule? All right, let's see. I try to do this on SPY. This will go into the ghetto spread thing. So yeah, definitely try it out. You definitely want to understand how it works. You could do it on a paper account, or you could just kind of look how it works and fake trade it. I think you could actually, what I think you could do is you could possibly actually on Robinhood, you know how like the Robinhood has the option watch list thing? I think you could do that with debit spreads as well. You can like make a watch list for a debit spread. I could be wrong, but that's a possibility. Is there a way to see gamma wall by looking at option chain, or do you need additional? It's usually better to see. You need additional software. One that I love using is Unusual Whales. You could check them out. Again, I'm not sponsored by them. I'm reading, I read most on main chat, but I'll just read on both. Gamma wall, we'll get into the subject another day. It's an important subject. Do you have to close both sides, i.e. sell and buy when you sell the spreads? Yes, so if you, that's up to you. If you want to exit the debit spread ultimately and you just want to be out of the trade, yes, you need to exit both trades. But that doesn't mean you're obligated to, you have to do that, right? So here's the complicated part. If you just want to remove the leg that you sold, you can do that easily, right? You could just do that, and then you just have to pay back whatever the value of the contract is at that time, and then you have the call or the put that you just bought. Now where it gets complicated is where you want to remove the leg that you bought, and then you're left with the leg that you sold. That's where it gets complicated, and there's a lot of times where you kind of won't want to do that, because then you're just selling a naked option, and that requires collateral. And that's where it gets a lot more complicated, and I have personally not done that because I don't find usual reasons to do that. The risk to reward is just not there, so forget about that. I personally would forget about that, and you just would look at it like, okay, all right, if I'm in a put debit spread, for example, and I enter this spread, and then let's say 2 days, Amazon just bounces up a little bit, and I think, okay, it's really going to reject really hard. I can close the put that I sold in this case, because it will obviously be profitable on that contract itself, because that contract lost value. So I'm buying it back at a cheaper cost, and I still have that contract that I originally bought in that debit spread. So I just keep that put I just keep that put call that I keep that original put that I bought, and then of course, if Amazon does that to reject, the profit that you get is going to be much bigger than holding on to the debit spread. All right? But again, the downside to that is if you have a smaller account, then you need to have enough where it's not risking too much of your portfolio to just hold on to that one put or that one call. That was the call or put that you bought in that debit spread. Hopefully that's not confusing. Huge ER drop despite being very high expectations. Yeah, I mean, when it's come to earnings, the past, year, you have to realize a lot of times, like, we've have a lot of dumb traders at this point because they have very high expectations, and obviously when it doesn't meet those high expectations, they overreact. I mean, take AMD or Amazon. You know, AMD did not do well on its revenue for data centers, but it did well on the other parts. But of course, there was an overreaction in selling, and AMD is very down after earnings, right? If I pull up AMD's charts, right, you know, you could see where it is. It kind of regained a lot of its price yesterday, but again, back, it's back to being the American money destroyer or the
Let's
advanced
go.
money destroyer. But this is where trading tech earnings, especially in a very volatile market, becomes less and less logical because the outcomes are a lot less predictable. And that's why you want to look. That's why I personally would want to look at less volatile stocks. That's why I looked at IBM because it was less volatile than, let's say, I think Meta was reporting that day, and what else was reporting that day? GP, Meta, and Google.
Oh God, I don't know. I
Yeah,
I took Uber. Yeah, I took Uber,
yeah. So it was
and I
Meta
got
and
smoked on Uber.
yeah. So on the day IBM was reporting, I know definitely Meta and Google was reporting. I'm pretty sure, or it was Meta
Oh
and
no,
some of them.
Google. I'm so sorry. I thought I said Uber. No, no, Uber was another day. Sorry.
Okay, yeah, yeah. Okay, cool. Okay, so I mean, obviously, IBM is lower IV than those two, and it's less volatility. So there's more chance of there being smarter investors in a stock like IBM, because of course, yeah, I bet half of you guys don't even know what IBM does these days. By the way, IBM created the first smartphone, FYI. So it's a boring company, so less people are looking at it. There's less dumb investors, so there's a lot more logical movement when it comes to price action. Same reason when it comes to Eli Lilly. I've been talking about Eli Lilly for weeks now. I've been saying it's in this bearish channel, and if it were to report positive earnings, which again, you can look at other stocks in this sector, such as AbbVie, and you could see that AbbVie did really well on earnings too, and AbbVie reported before Eli Lilly. And even though it's not the same thing, but it's still somewhat in the same sector, ABT reported really well on earnings, right? So you could kind of think like, okay, all right, if those companies reported well, there's a little bit of a higher probability that Eli Lilly could report well as well. And then you also want to look at these setups, right? If you just think something's going to go up and beat earnings, okay, cool, yeah, sure, it can. But what is there a setup there for it to be valid? If there's not, then is there really a point in taking the trade? Like for example, if Eli Lilly already was in a channel that was like this and price was already increasing, I personally would not be taking calls on this, even if I think Eli Lilly is going to be earnings. Because yes, of course, it could skyrocket, but the upside is way limited compared to when you have a setup behind the earnings trade. This is a setup that gives you a lot more upside versus if this is a bullish channel. IBM, for example, if you go to it, gives you a great setup because you had a bearish channel and it was breaking out of it and it was near all-time highs. And you could also see you kind of have like a pennant. So that was a setup there. If you go to, what was the other one that I was in? Affirm has an amazing setup. If this was a bullish channel, I would not have taken shares on Affirm and I would not have taken a debit spread. The fact that it was in a bearish channel and it was very bullish near earnings and it had the double bottom, this made me realize like, okay, all right, this has a lot more upside potential. And if I go to a weekly chart, you could tell it has one of my favorite patterns here, which is the ascending scallop. And between those points, you have cup and handles, right? You have multiple cup and handles, no matter what way you look at it. So there's multiple patterns heading into a firm's earnings. So that's how I trade earnings, simply put. Let's see. Yeah. Right, there's not a question on debit spread. I need to understand what is your exit strategy after you do first trim. Do you allow stop at break even or you let it go at a level even if the price goes below what you bought? For example, PET, what would be that level? All right. Okay, so let's go to, I think you guys could ask your final questions about debit spreads, or you could put a few tickers that you want me to look at, and I'll look at maybe a few of them. Meanwhile, I'll just answer this question. So I took PDD calls and I took Qualcomm calls. PDD has a higher chance of working out versus the Qualcomm. That's why I said specifically I went very even lighter on Qualcomm than I did on PDD. And PDD calls, I'm gonna call P Diddy stock because it's much easier. The P Diddy stock calls, I that itself I already went light on. So I'm not in a heavy position on this. But the reason why I went into P Diddy stock calls is because, first of all, the candle is very bullish here. You have a nice wick to the downside. And if we creep to the 30-minute, you'll see we have a nice pattern here, right? Or pattern, whatever we want to call it. You have a pennant, and additional to the pennant, you have consecutive higher lows. And even though you do have a lower high, you're attempting to create a newer higher high right here. So I'm trading this. I'm trading the breakout of this. Now your question was, how do I determine where I'm going to exit? Well, two things I want to say. One, my risk tolerance and my risk management is always going to be different than yours. I have on Discord a very important thing that I typed out here. In fact, I'm going to copy this and I'm going to put this in resources. This is a whole thing which talks about how you could potentially figure out a risk strategy, which is very important to do and figure out. So you could do that. You could look at that, and you could also answer this question yourself. But I'm gonna just tell you what I'm looking at and what I'm gonna do with P Diddy, right? Pause. Basically, the swing trades I take, I know very quickly if it's going to be invalidated or validated. What I mean is, I talked about this last time. My swing trades, I would know by the next day, usually, or the day after that, if it's going to be valid or if it's worth getting out of. That's just the way I enter. That's the entry points I take, right? Because I want to get the exact point it's going to move instead of just getting into a trade and just waiting for it to work. So if I'm looking at P. Diddy's stock, I'm thinking, okay, where exactly are the crucial points, since I'm in calls, where are the crucial points for support? Well, that's going to be 110.85 because that's a place where we bounced off recently. In fact, that bounced off, today. We held that support. So if P. Diddy's stock breaks below that, I'm already going to be cutting. I'm going to be looking to cut. And yeah, I mean, that's all I need to look at, to be honest with you. Because then here's the thing. If I go ahead and I'd be like, oh, there's also this level over here, and then there's this level down at 108, then I'm just giving myself more room for this thing to creep down and just make me lose more money and then get invalidated even more. So here's how I literally go through this. Let's say tomorrow P. Diddy's stock does not open green. Let's say it gaps down and it goes from let's say 112, right? Because it's 112.71 right now. It goes to 112 and it tests 110.85. I'm not exiting if this just breaks below. I'm exiting only if the 30-minute candle closes below 110.85. Why am I waiting for a 30-minute candle to close below? Because we could see here that no 30-minute candle really closed below this area, right? So that means that even though it's creeping down to this area, there's a potential chance it could bounce. Now, here's another factor I'm also looking at. I am not going to be in a big red position when it comes to a swing. Day trades are different because you have a little bit, you can average down and you could de-risk very easily, versus swing trades, the swing trades I take, I'm expecting them to work out pretty quickly. So if the contract, when it reaches this point, which theoretically, if P. Diddy's call, if that call was to reach over here, it's probably going to be down only 20 to 30%. So I'm not really worrying at that point. But let's say if it's already down to 40% and it's actually breaking below, and even if it didn't close, then I'm going to think to myself, okay, you know what? I'm not taking the risk. I'm just going to exit here. Because why risk that? Because yes, of course, it could bounce and then close above it and then go up. But I'm not also going to risk the fact of it actually just continue to breaking down. So then let's say it holds this, right? And let's say it actually breaks below, but the contracts are only down 20%. Then I could think, okay, all right, if I'm personally okay, and this is actually me thinking, this is what I'll think tomorrow if it gaps down. If I'm okay losing, let's say 30%, I am okay with I'm okay with it actually coming down and testing 109.66. Right? Just this area. Again, I always said that levels are not always precise. You always need to look at areas of interest. So it's always just this. You want to leave a small room of error. So if it's only down 20%, I'm gonna wait. I'm gonna be like, okay, all right, maybe I'm okay with losing, risking 30 to 35% loss. So I'm gonna let it see if it bounces before it reaches 109.66 or if it bounces at 109.66. And if it bounces, then I'm like, okay, all right, what we'll have here is a gap down and it bounces like this, and then I would have to adjust my trend line to make it look like this, or I could just completely remove this trend line and then think, okay, so now what we have is a channel, because channels always have outliers sometimes. And I'm just going to focus on the areas where it's just bounced up most of the time, and I'm betting that it's going to break up into the upside. But again, if the option is down too much, I'm not going to risk it, because why do I need to risk it? If it's down a lot, if it's not down too much, then I could be like, okay, I'll risk at least like 35%, see if it bounces here. If it's already down 30% and it's breaking below here, then I'm going to exit. If it's down only 20% and it's breaking below, I'll be like, okay, all right, let me see if it can hold here, come back up and close, so on and so forth. Now, let's say your next question is, well, how exactly will I deal with runners? That's already on my how I trade document, so I'm not going to go deep into it. I set my trims according to profit percentages. That's why I get better trims than most of you guys, because a lot of you guys like to manually trim. It's not a shot at you guys, it's just a fact. And I always get filled a lot easier and quicker. One, because I'm on Thinkorswim, and one, my order's already there. So yes, I could potentially lose out on some profits because I'm waiting to, instead of manually trimming and getting the best point, I'm just making sure I'm securing that if the contract reaches that area or that price, I will get trimmed out at that point, right? So I will set it, let's say if P. Diddy's stock gaps up from 112.71 to 114. That's probably going to be a 30% gain. So what I'm looking at is I'm going to start before market opens. What you could possibly do, by the way, is this is where Robinhood's option calculator could possibly be helpful, even though I talked about it last time where it does not calculate IV increase or change. So if P. Diddy stock were to gap up, and I look at the option simulator for the call that I have, I can at least get a guesstimate of where it could possibly open up at the minimum, and I could set the trim percentages closer to that point. So I don't personally use it, but that's a way you could possibly use it. So if the option calculator is saying, like, after a small gap up, if an option calculator is saying, hey, it's going to be up only 10 or 20%, or let's just say 10%, maybe you don't want to start putting your trims at 20%, because the IV is not going to increase that much. So you're not leaving yourself room for error. But let's say P. Diddy stock gaps up from 112.71 to 116. The IV will definitely increase from today to tomorrow, right? Because tomorrow is when we're going to be exiting the trade or trimming our trade. So then let's say if the option calculator on Robinhood is saying, hey, you're going to be up 40 to 50%, or just say 40%, I'm going to maybe start setting my trims, maybe a very light position at 40%, but I'm going to start putting the heavier trims at 50, 60, and 70, because the IV can increase, which could then inflate our contracts from 40% profit to 50% profit or 60% profit. When it comes to leaving runners and stuff like that, I kind of explained that on the How I Trade document, and you guys can find that on literally the messages I post, where you guys, whichever Discord servers you came from, so you could view that. Yeah, so I'm not glued to the monitor. Yes, that's absolutely true. A lot of my trims I only figure out because I get a notification. The only time I'm actually looking to actively trim is, of course, near open. So I set my trims out. Like I don't like, if I say let's say I have 10 contracts. Let's say I have 100 contracts. I'm not setting trims for all those 100 contracts. I'm setting trims for, let's say, majority of them. That could be from 60 to, let's say, all the way up to 80. So let me bring down to a realistic trade for you guys. Let's say I get into 10 contracts. I'm only setting trims for 6 to 8 of them. I'll probably leave 2 that I can manually trim, because let's say, for example, Bank of America today, let's say it went up all the way, by the way, to close to 100%. I think it went to 80 or something like that. But let's say Bank of America did not continue to the upside and it just started retracing. I still have those two manual trims that I can quickly just, secure some profits right away if I see it coming down. So majority of my trims are already preset, and if I feel like I need to make adjustments, I'll do it. But I personally do not like doing that, because the greatest way I've personally learned in my experience is for me to be a lot more profitable. I like having runners, and you guys have clearly seen from my trading log, I have very above average returns on average option trades. So I like letting my runners run. I like seeing where it goes. So I can risk, in my financial situation, I can risk letting my runners run. So you need to think, please, this is not going to be, 100, 180 is going to, make your trading better, but maybe it could bring a perspective that you didn't know you needed. So please read this when you get time. The resources thing could be helpful, could not be helpful, but, it is what it is. All right, so I guess now we'll get into the examples. Okay, I only got Moderna, so I'll look at Moderna. Moderna is obviously risky because.
mRNA.
Thank you, man. Moderna is risky because, well, look at it. Looking
Oh
at this,
God.
yeah, I know, dude. Can you believe it's down to $33?
Oh
Like,
God.
I actually, I got into a credit spread for Moderna, by the way, right here, right on this candle. This is a perfect bullish candle, and if I were to go right back here, it's so funny. If I were to go right back here, this was a great setup for me. It's not the best, but it's great because I had this, and I had basically a falling wedge, even though it looked very ugly. The only downside was the fact that I'm buying it right at the trend line. I should have bought it right over here because this was a perfect candle. So I got credit spreads. I got completely smoked on these because you know what happened? Moderna came out. There was Moderna news. You could correct me if I'm wrong, JP. There was like some news where something got rejected, or like there was a lawsuit against Moderna, and then you guys can see yourself. I mean, this
I
came,
I know what you're talking about, but
yeah.
I can't remember if it was something that the federal government something. I can You're right. There's something along that. What up?
So this day itself, I was like in put credit spreads. It was like the $40 strike. I got smoked on these. I had to exit for a big loss. The reason I'm saying this, Moderna is a very, very, very volatile stock that is news oriented. One news can literally change it drastically. This was a bullish setup. News completely changed it. And now from looking bullish, it's bearish. You could say, hey, there's a possible double bottom coming up, but I mean, look at the candles. What's showing you here that, it's going to be bullish, right? So right now, if I were to look at Moderna, let's say I'm bearish on this. I mean, here's the thing. What's the downside? There's not much downside to it, too. Okay, let's just say, for example, worst case scenario, we're just really bearish on Moderna, or we have you have some insider information that Moderna is gonna get smacked by Trump, and just like Trump said his idiotic remark of saying, "Hey, we're gonna occupy Gaza," he's gonna say, "Hey, I'm gonna buy Moderna," and then Moderna stock tanks, right? So let's go to the option chain for Moderna. Let's pull up Moderna. All right, this is gonna be a swing, and we're thinking, all right, just looking at this chart, we think it's going to test this previous resistance, right? Which is, if you guys remember previous live sessions, previous resistance, if you break above it, it becomes support. So we think it's going to come down to this area around $27. So let's go to the option chain. Let's go for, let's say 3 weeks out. I'm just picking a random number. I'm going to switch to a put side because let's say we're bearish on this. And we're thinking, okay, this is a support level, so there's a more likelihood chance that it's gonna bounce off of this, right? Because supports have a higher chance of working than resistances. So we want to make sure we get into a safer trade. So let's say $30. We're gonna look at $30 for Moderna. We think it's gonna be below $30 in. We're gonna reduce the time frame in 2 weeks. So we're gonna go to $30 put. We're gonna sell that. And we're going to buy, let's say for example, we'll just look at the 30/50. So the difference, did I do this right? Yeah, I did this right. So the difference of these two, man, do I really have to do the math again? I'm so sorry, guys. I'm so dumb right now. I need food. So we're entering at $50. Did I do this wrong? I feel like I did this wrong. I did this wrong. No, I did this right. Why is it not working? JP, could you help me out here?
I'm sorry, what did you say?
Hold on, this option change is out of whack. What? It's so weird. Yeah, never mind,
What
hold
are you
on. That
trying to do here, buddy?
Yeah, I don't know. All right, let's do this. So we think it's going to reach $30, so we need to buy the more expensive contract, which is 31 puts. So the difference between this is it says right here 63, so let's just put 63. And you could see you're risking $30 for 40 max profit. Is this good risk to reward? No. That is why when you look at these stocks, you want to make sure you're in a possibility where there's more potential upside or downside for your trade. So Moderna is not a great stock to look at because the stock is more bearish, but even though it's bearish, there's not much downside to it. But let's just say, for example, you're looking at Moderna and you think it's going to double bottom. Then you're thinking, okay, where is this stock going to go? Let's say you want to use fib extension, even though it's going to be an ugly fib extension. You're going to draw this out over here. And you're thinking, okay, all right, I could have two possible targets, the previous high or this fib extension level at basically $55. So we'll go to Moderna and let's go back to 15 days out. Hopefully the contracts are not weird on the spread. We'll go to we'll go to the passive one. So let's say we think it's going to be above 46. We're going to go to the calls, go to the 46 calls, if there is a 46 call. Yeah, there is. So we're going to sell that and we're going to buy the expensive contract, let's say the 45s. And the cost for that is going to be 11 cents. So we're going to put 11 cents here. And then you will see you're risking $11 to make $90 by expiration. And you could see here, if it's before that, then you can make like some profit, but not all profit. So that's just an example. I'm kind of running on few brain cells here. So I'm going to actually skip over to the last few parts, which is the option calculator. The option calculator can kind of show you a better example of what's going to happen. So let's actually go back to here and, wow, this is all ugly. Let's delete all of this just so I can read this a little bit easier. And let's take this Eli Lilly trade. So your main question is going to be like, hey, okay, all right, let's say, I don't want to hold the trade all the way to expiration. I just want to exit out beforehand. Let's take this exact trade and let's take it to an option calculator. So we're going to go onto a website called Option Strat. I think it has a more visually appealing option calculators. We're going to go here. We're going to go to build, right? The website is called optionstrat.com. We're going to go to build. We're going to go to debit spreads. We're going to go to bull call spread because if you remember, we were looking at a bull call spread for the Eli Lilly example, right? The debit spread. And then we're going to choose the strikes. We're going to change the ticker to Eli Lilly. And then we're going to go to the expiration. So if we go back here, the expiration was March 7th. So we're going to go to March 7th. And our strikes was we bought the 950 and we sold the 970. So we're going to take, this is the buying, right? No, this is selling. So we're going to set the 950 as a contract we're buying because this is the buying side, right? It shows 1, right? Versus the selling side shows -1. So we're going to set this to 970. So we set that to 970. All right. And then we're going to see here, it's going to bring up the similar prices as we saw here on the right. So let's adjust this. So actually, let me adjust the debit. But this should say 269. Again, it's because near end of the day, that all these spreads go whack, or all the option contracts prices go whack, you could see here that if Eli Lilly were to come up to, for example, 950 by, let's say, February 14th, we're already going to be up $629 on the spread. If it went only to, $898 or close to $900, you're going to be up $94 on the spread. So you can actually come to the Option Strat website and you can actually see how exactly it's going to change throughout. You can also make it a graph and you could kind of see, like, okay, by, let's say, February 21st, you know, how much profitable would my spread be if it's at a certain price? Like you could see here, if Eli Lilly with this spread was at 930, and by February 21st, it's going to be $347 profit, right, for that spread. So definitely come and check out Option Strat if you want to get a little bit more understanding on how you could also exit out beforehand for profit as well. All right, but I'm gonna answer this last thing about what's my thoughts on KHC, and then we're gonna call it wraps because I'm very hungry and very tired. Looking at it right now, I'm bullish. That's just me giving a quick look because what you have is a double bottom, and you have a somewhat of an okay bullish candle. If we go to the weekly, you have a little bit better weekly candle, especially if this gaps up tomorrow. This will create an even better weekly candle. You can see that this level over here actually draws back all the way till when was this? Around September 2020. So it's a pretty old level. So if we go back to daily, you see, okay, possible double bottom. Let's go to the 2 hour. Let's see. All right. Well, right now, it's not the most bullish candles. So maybe you might want to wait for confirmation. You could say you have a miniature level right here. So it held above 28.93. So it held the top of this range that we had over here. Now you kind of want to see tomorrow. How would you kind of trade this? Well, if you're in calls already, then you're already risking it. So you kind of don't want it to get below 28.93 or this double bottom if you're riskier. And how you could enter this if you're not in it, or what I would do is I would try to find a resistance that it's important to get above. So let's say this gap, so 29.26. I would wait for it to come above here, reject, come and retrace, and if I see it bouncing off this, that's when I'll take calls. And that's when I'll get into KHC calls. So that's my thoughts on KHC. Alright guys, we've been going for 2 hours now, so I'm gonna call it wraps. JP, any final words before I say my final words?
No, I'm calling it a wrap as well.
Okay, well, this was my whole thing on debit spreads. I mean, this is a really great strategy you guys can use. Small account or not small account, it's amazing. And, I put time into this, and I put time into this because I think it's a very important strategy you guys can use. I use it, and I don't have a small account. So it's just great. I'm gonna post this recording tomorrow so you guys can reference it. But I really hope it stuck with you guys. If not, to each their own. But it's a pleasure talking to you guys. Again, I hope it was valuable. Next week, I post this schedule. Next week, we're actually gonna have. Did JP leave? No, JP's here. So next week we're gonna have example debit and credit spreads, but I'm gonna scratch that out. And maybe JP, you want to talk about intro to bonds on Monday, or you want to talk about on Thursday next week?
Let's talk about intro to bonds Thursday of next week. Let's talk about why don't we do EMAs?
EMAs? Okay, all right.
Yeah,
So you're
that's
fine with taking 2 sessions on next week, or are you gonna be the head?
why don't we do EMAs next week? Skip bonds. You do one, and then the next week we do bonds.
Okay. All right. Yeah, sounds good. All right. So on Monday we'll do EMAs, and on Thursday I'll figure.
Introduction to moving averages.
Okay, cool. All right. So we'll do that, and on Thursday, we're going to go. I'll pick a topic for Thursday. I'll just figure it out. Right, guys, it's been a pleasure. I'll look forward to, reading your comments. When I upload the video, please leave a like or subscribe to our YouTube channel if you haven't.
Absolutely.
All the links are in here, and you could definitely subscribe to our YouTube channel. But it's been a pleasure. Thank you so much. But peace. See you guys. All right.
Later.